Welcome to everybody. Good morning or good afternoon, depending on where you're joining us from around the country. And thanks for logging in for this week's Pro Perspective. I'm your host, Matt Kors, here with Crexi, and today is going to be a fun one because myself and really the whole Crexi team have known these two gentlemen for a long time. We're zoomed in with Tivon, Moffitt, and Peter Bauman, part of the IPA group with Marcus and Millichap in Phoenix, and I really kind of like the story here. Tivon, you have an East Coast financial path from New York and South Florida into commercial brokerage. And Peter, you were doing investor relations and P&L forecasts for mining operations in West Africa. But both paths kind of crossed at Colliers, where you were co-chairs of the Net Lease Group. Then on to JLL, the National Capital Markets and Institutional Investment Sales Group. And then last year joining the Institutional Property Advisors Group at Marcus and Millichap in Phoenix. So thanks for joining us today, gentlemen. How's everything going over in Arizona today?
Fantastic. It's beautiful. I think we have a high today of 106, and tomorrow we may have a little bit of a cold spell, and the high might only be 98. And rain may be in the forecast for the first time in a long time. So we're excited.
Yeah, Matt, thanks for hosting us. This is great.
Yeah, no, we're obviously excited to have you guys on, and I think the audience too is pretty excited with the topic today. And a quick logistics for folks that just joined as well. So we've got a chat box and a Q&A box for anyone that wants to ask questions. We invite you to ask Austin. But yeah, please hit the Q&A box, and we'll get to that and as close to real time as possible. And then the other thing I wanted to throw out there too is we're going to throw a couple polls up, or kind of like a segment up. And so the first one we're going to do here is going to be, we're going to toss it up right now. So in today's topic with industrial and office, we pulled some data here at Crexi. And what do you think from a product type standpoint, office or industrial, has seen the most increase in buy actions and website traffic, office or industrial? So everyone should see that up on their screens now. And yeah, feel free to answer on there, and we'll get some answers back to everybody when they've answered. But do you guys got any thoughts on your end?
Yeah, so thoughts on my end would be that industrial product has been in high demand and will continue to be in high demand as we see this pandemic roll through the global markets, and as e-commerce becomes more and more prevalent, and supply chain logistics to just general economic cycles.
Yeah, I like it. And I think too, guys, let's, just to get right in here, industrial, I think, and I could be wrong, but it's probably been the darling of the COVID world, if you will, since, and this has all happened, and maybe not so much office, but I could be wrong. I'm interested to what you guys think. In general, I guess just to kick it off, like in the market today, what is driving the industrial and office, net lease sales, marketing, everything in those lines? If we should unpack that into two questions, please feel free. If you want to start with industrial and then go to office, let's kick it off with that.
I think the overarching, it's just the safety of it. So especially if you've got strong credit associated with either office or industrial, there's just an incredible amount of people that just want to ensure that they're in a safe asset. And so we're seeing interest that is way beyond what we ever saw before for projects that we have out on both the single tenant office side and the single tenant industrial side. And in today's environment, people want to know that their capital is safe, and they could pull that capital out at a later point if they want to go pursue distressed opportunities. But we don't know when distressed opportunities are going to be in the marketplace. It could be another couple of years. And so, especially on the industrial side, we're seeing a lot of capital that's coming out of other sectors, whether it's retail or hospitality or multifamily. And people just want the low management responsibilities, and the capital continues to flow domestically and internationally.
No, that makes a lot of sense. Is there, in the industrial side, is it primarily like logistics warehousing, or is there a lot of other stuff going on besides just that too?
The logistics warehousing is the darling, and we're
Okay.
seeing significant cap rate compression. Um, that said, there are plenty of other companies that are very strong credit, and even companies that have lesser credit. Just the historically, people have looked at industrial as having lower costs of retenancy and exposure, and if a tenant should leave, if it's well located and has good components to it, it should be relatively easy to find a replacement tenant at a favorable rent. So we're seeing tremendous interest there. Now, what's interesting, and a lot of reasons why people are attracted to the single tenant office space, is because there is a yield differential, even if there's long-term and strong investment grade credit. So some people just are not comfortable with the cap rate yields that are available for strong either e-commerce or just strong investment grade industrial tenants. And single tenant office provides a good yield opportunity, and debt is very available and plentiful in both areas.
That's interesting. Okay. And is there, as as the industrial side has that, is there anyone in particular in the office space, like sector wise, that's really, kind of boosting that or driving that, like with interest? Is it medical tenants in particular? That's what comes to my mind, but I could be off on that.
Yeah, single tenant medical office investment is very strong, and there's a lot of institutional and private capital players that are extremely active in the space right now. I would say from an institutional side, there's a lot more institutional interest and activity on the single tenant medical space than on the single tenant office overall. And it just goes back to the overall themes of stickiness. And what's also interesting on the medical side is it's a lot more prevalent to be able to find longer term leases associated with those users. So easily getting over 10 years, whether it's 12, 15, 20 years, maybe not so much, but it's very difficult to find a non-medical single tenant office lease unless it's a large campus that's over 10 years. And so we find a lot more capital is flocking to the medical space because you can find that term, you have that perceived stickiness. And there again, cap rates have been compressing very significantly, even during COVID.
People just not wanting to move, I take it too, right? You're a medical tenant. You probably got a lot of stuff going in that building. You're not trying to be moving month to month, I'd assume.
Completely agree.
Not month, year to year rather, but yeah, no, completely
Right.
understand there. Nice. Kind of a side note, but personal question for you guys: how did you guys get into this space versus like multifamily or something like that when you were getting in there? Because this is obviously a good space to be in.
Yeah, 100%. I would tell you if I could do it all over again, I might just put my multifamily hat on. But all joking aside, I think one of the factors is just what interests you, right? And so office and industrial space was something that I found very fascinating early on in my career, and it was just something that I was drawn to, and I explored more and found a lot of great traction into. It's interesting to see, where companies want to locate for their space, and right now in today's market, you hear a lot of people hesitant on office because of the work from home model, and
Mm-hmm.
what I've been telling clients is, all these companies and big corporates out there, they talk about culture, and they hammer home the word culture. Well, what is culture? If everybody's working from home, you lose that connectivity. Everybody wants to have a space that they can go to and call home and be gravitated and be a part of. And so, I think the work from home model works for a lot of different companies, but at the end of the day, I think we'll see a resurgence of employees desiring to be in an office setting and collaborating with their employees.
I think Peter, nailed it for me as well. I mean, it's really important that people are attracted to what they find interesting in the space. And in my background, doing strategy, management, operations, consulting, and being on the operations side of a large Fortune 500 company, I was always used to that office and industrial environment. And that's what I found interesting. We joke with our very successful multifamily colleagues, and they're like, you guys have it so easy in terms of being, working on single tenant office product. And we joke back to them that, it's so easy on the multifamily side because your NOI is always changing from month to month. So, there's so many different interesting components to the commercial real estate landscape. And, we enjoy very much what we do and are lucky to be able to have so much fun as our job and our career.
Oh, for sure. No, great answers there. Thanks for clarifying that a little bit for me. So from a growth standpoint, in like long term in both of these areas, industrial and office single tenant, would you say this would be like one of the most competitive areas going forward, just with what's happening in the industry now? And do you think like shops and brokers are space, kind of like you maybe saw with refinance over the past 10 years, or is it too kind of tough to get into? Is a barrier to entry a little bit higher from that? I know it's kind of a loaded question.
So it broke up a little bit. But so the question is, barriers to entry in terms of brokers getting in the space, or barriers of entry in terms of
brokers getting in the space. Kind of like brokers getting in the space, what you guys would see.
Yeah, I mean, I started my career in the commercial real estate space in 2004, and I made a conscious decision in 2010 to relocate back to Phoenix, where I was from. And Phoenix was knee deep in the middle of a very deep recession and challenging economic climate. I think it's a very hard industry. It's a very difficult industry, but if someone's interested in it, I think the best time to get into it is when there are difficult economic times. There's changes in the marketplace. People need advisors more than ever because we're in the thick of it day in, day out. I mean, there may be a reduced transaction velocity occurring, but we're getting projects completed, and we're working with numerous institutions and owners. Our information is more valuable now more than ever. And so I would encourage, if someone's interested in the space, it doesn't matter if you're in an upcycle or a down cycle in terms of the economy. It's very easy to be successful when the economy is roaring on all cylinders, and that's great. But I moved back here. Peter also got started in the industry during a downtime. I think it's the best time to do it. And if someone's got the tenacity and works hard, you can have tremendous success in this field.
Yeah, and to echo that, I mean, I think if people are trying to, switch careers or break into an area of commercial real estate, you just have to go where your passion is. And if you're not passionate about something, you're not going to be successful. And so, it really, only you, when you look in the mirror, can answer that question: is what do you want to do, and what do you want to be known for? And so, unless that passion's there, your day to day is going to be a challenge. So I would say that you just gotta go with what feels right.
Yeah, no, for sure. I agree with that 100%, guys. That's a good answer. So you brought some up there, like looking back on it now, like what did this space look like back in the 2010, 11, 12 time frame, when you're kind of coming out into the recession and then out of the recession? Is it similar? Is it different?
I think it's extremely similar, with the one difference being, of course, this is a global health started situation. This wasn't coming out of financial problems, subprime problems that basically cratered the sector. But I think where there are a lot of parallels, if you go back and look at the single tenant office landscape, and we've gone back and we've studied transaction velocity going back from 2000 to 2020. And in 2007, we saw the peak of sales occurring, and it didn't recover until that same level until 2012. Now, I'm not saying that to scare people, but we saw the bottom in 2009, and we went from almost 150 single tenant office sales. We're looking at 50,000 square feet and above, so larger projects. And then in the bottom, and this is by quarter, so not summary, but in a quarter we had almost 150, and then in 2009 at the bottom, the quarter was roughly 25. And then again, in 2012 we were back. So, that number is not meant to scare people. There's still plenty of transactions that are getting completed, and there are still plenty of transactions getting done then. It's just, you have to be more creative. You have to be more involved. You have to really make sure that you're adding value to the process and finding the right price to sell something at, and the right buyer, and getting the right debt associated with it. So it's more roll up your sleeves. But we do anticipate, we saw, just to take a look back in earlier this year, we had on the 50,000 square feet and above, I think in Q1, we had roughly 175 sales. So well ahead of where we were in 2007, 2012. So the sector is very strong. We're going to see a decline in those numbers, but there's still plenty of capital. There's a lot more capital available. There's a lot more knowledge about the space, but it's going to be harder to get transactions done, and that's okay. And that's where we as advisors really earn our keep and provide more value. What's great also, look at with Crexi, we've got a lot more technology tools at our fingertips and a lot more data and information and value that really wasn't readily available so much 10 plus years ago.
I think it's really difficult to compare the great financial recession of 08, 09 to a global pandemic. And I think that what's interesting and fascinating about it is that nobody knows how this global pandemic is going to roll out and affect work patterns, supply chain, logistics. You hear, when this happened early onset, everybody was talking about a V-shaped recovery. I think it's safe to say we're not going to see a little, V-shaped recovery. It's going to be a little bit more long drawn out. And in addition, you're hearing, in the industrial field about, reshoring supply chain, and that we had too much of our supply chain was dependent upon overseas and this global economy, and you can't have the whole world shut down at once because of a virus running across the globe. And so being able to shore up your manufacturing facilities and being able to provide more on a localized basis, I think you're going to see a lot more of that happen this market cycle, and I think it's going to help fuel the recovery.
Yeah, for sure. No, I think that was spot on with those answers. I appreciate that kind of knowledge from back then until now, gentlemen. We had a couple questions come in from the audience. So first one, would you explain the differences that you see between Class A and Class B industrial and office warehouses? Whether that means breaking tenant rent collection, lease activity, vacancy, and cap rates. So I know that's a little loaded there, but I guess to start with the differences between Class A and Class B and how maybe you identify that.
I think the differences between them is maybe more market locations and product type. Class A might be more modern, higher clear height, newer designed asset. Class B sometimes may have lower rents associated with them. I think that from an investor demand standpoint, there's very much interest in both. People are on the industrial side, people are comfortable with investing in Class A warehouses. They're comfortable investing in Class B warehouses. It really comes down to the age and the condition and the components to it. I think a lot of the institutional investors are more driven to more modern design, modern prototype, knowing that if the tenant leaves at the end of the term, there's flexibility in terms of being able to replace it. But I think underlying components really are focused on what's the credit, what's the duration of the term, and for some shorter term assets, there might be a little bit more openness to Class A buildings or either Class A or B that have low rental streams, so there's downside risk protection. But I think in many markets we're seeing very low vacancy on both the A and B side, And so, just investor demand overall is strong for both categories.
Yeah, I think to echo that, to specifically answer the question, Class A versus Class B, I would say that's age of the facility, the functionality and format of the building. Clear height is, essential. We're seeing clear heights, going in the 40 to 60 foot clear, where, Class B space is probably tapping out at, 25 to 30 foot clear. It has to do with, how many docks they are, is it cross docked access, where it's located to different modes of transportation and logistical freeways. So, it's a loaded question. Cap rate differential, it's gonna vary market to market. I would put A versus B anywhere from a 25 basis point and higher differential.
Okay.
In certain markets. Some it could be tighter than that. So it's just really market specific.
Needless right now, it sounds like.
Say that again, Matt.
Both are very hot right now, regardless, Class A or Class B, though.
100%.
Yeah. Okay, so another one we had come in, Phoenix market in particular. So this is specifically for you guys. People working remotely or at home and losing their jobs. Do you expect multifamily arena to be more stable or less stable, comparing it specifically to office industrial? In other words, do you see one of these sectors to be weakened or strengthened?
So our expertise is in the office and industrial sector. So multifamilies outside of our space. So I'm not as much of an expert there. What I would say is, for Sunbelt states in particular, we expect that there's going to be significant migratory trends coming out of urban environments. So in Phoenix, whether that's either from San Francisco, LA, Seattle, or from Chicago, New York, Boston, we see it from all over. And those people need a place to live. I can tell you that, and I think this is similar in many other Sunbelt states, housing inventory is very low. Housing prices are going up. From what we've heard anecdotally, rent collections have been very strong for multifamily side. So in terms of investment thesis, we've seen from our colleagues who are very successful in the multifamily arena, there's been continued demand across all sectors. And I think, for those reasons as well, there's going to be a strong demand for single tenant office and industrial. I think right now people are saying, we don't know what strategies are going to be from work from home. And Peter talked about culture beforehand. I would encourage people to take a wide lens in terms of thinking about the office space. The office space will be back. Corporate CFOs do not want to spend more money on real estate to the extent that they can come up with some new strategies and have some people working from home and some people in the office. That's fine. But I think there's still going to be the trend to have dense office environments. Hopefully this virus will be a thing of the past at some point. And I always talk about Nortel. Nortel was a huge telecom conglomerate, and going back in the late 2000s, they had decided to roll out a strategy of trying to get everyone to work from home. And Nortel went out of business in 2017. So I think that for some companies, it can be very successful, but I do think that people will be fully back or mostly back in an office space at some point. And I know that many corporates that we're talking to are looking to definitely have a ramped up, phased in environment. And some companies may be very successful with completely working from home, but I think the vast majority of companies are going to be back looking at spaces. And I think from a single tenant standpoint, more companies are going to want to have control of their sole building. So I think we're going to see a lot more demand from that standpoint, and having more companies looking at being in their own facility and not necessarily in a multi-tenant project.
Yeah, what I would add to that too. So Phoenix specifically, over the last cycle, we were adding on average, I think it was 100,000 to 150,000 net new jobs year over year from 2013 to 2020. And so what does that do? You know, we're pro business like most Sun Belt states, and I think that what the trend in Phoenix probably translates across the Sun Belt and being we're pro business, we're open for business. Our tax environment is less, our cost of living environment is less. So you can have these corporate occupiers that come in, they can get great skilled talent, they have great cost of living's lower, quality of life is better than living in some of these states that have really high taxes and overhead. And so what that's done to the multifamily market, I mean, it's the last cycle, it's been, you know, tons of new development, single family housing, specifically in Phoenix, before the 08 Great Financial Recession, they were pulling like 60,000 permits for single family homes a year. This last cycle, they've been pulling 20,000 permits. There's a housing shortage in Phoenix right now. You know, I think I heard the last statistic was that there's like less than 900 homes available for sale in the market in the Phoenix metro area today. And so that tells me that there's demand. And as Tivon mentioned, prices are going up. I don't think that the multifamily market in the Phoenix metro is going to be impacted that severely by this pandemic. I don't think that the office market's going to be impacted severely by this pandemic. And I think the industrial arena, you know, market is going to just continue to be on fire here for all the reasons that people are moving industrial, you know, distribution, manufacturing, and warehouses and logistics centers here to this state.
Yeah, I can, you know, just opine on our end, man. The culture is huge. Like we love being in the office. We can't be in the office right now fully, but like we see it every day, and we've got our own space. We don't have anyone else in the building, and I think that's going to help us out when, you know, when it is time to get everybody back up and running in there. But yeah, that's for sure. And I know the cost of living is much cheaper out there than LA. So maybe one day I'll head out there if I can convince the wife. We'll see. But
it's
yeah,
amazing what kind of house you can get. Yeah, it's amazing what kind of house you can get in Phoenix and Scottsdale and Paradise Valley. You know, coming from Cali.
I can only imagine. So we had a couple other questions come in here. So we have how do you guys see the 1031 exchange appetite given the extended time frame, and how is this getting affected by the upcoming elections in COVID-19?
That's a loaded question.
They all seem to be loaded today, guys. I'm sorry about that.
Let's break it down into parts. So, I mean, 1031 activity, we saw an acceleration of 1031 activity, kind of, you know, as soon as COVID hit. I would say it's safe to say a lot of transactions fell apart, and there was pent up demand through, you know, like May into June. And I'd say by the July 15th deadline, I think a lot of those 1031 exchange buyers had found replacement properties, or maybe they have that so, you know, that the infamous accommodator that's out there in the market. And so, you know, I think that to answer the question about 1031 exchange activity, May and June we saw a lot of activity on our transactions, and we saw a lot of transactions from our colleagues getting closed. Coming into July and that 15th deadline, I think the velocity really slowed down, which surprised me because I thought we would have seen a lot more activity in those last 2 weeks of July.
Yeah, no, that makes a lot of sense. Thanks for that there. Okay,
I mean,
so we got a couple other ones. Oh yeah,
to answer the second half of the question, I mean, so the 1031 exchange, you know, that was extended to July 15th. People have either identified, so now they're going to close through October 10th, and then anybody that has closed property since, they're back in the normal environment of they have to identify a 45-day window and close within 180 days of their relinquished property. So how does the election play into that? I mean, that's you know, we're looking at the crystal balls. So
I think what I would say to that is, I mean, look at the stock market for the most part has had a really significant rebound. I mean, we've seen, you know, tech in particular has been on a rampage, but overall, most of the stock market's recovered. I think that we're seeing a lot of capital interested in the commercial real estate space because there were fears earlier this year of the stock market being overvalued. I'm not saying it's overvalued or it's not, but I think that we still see the same same trends of people saying, look, I want safety in terms of a commercial real estate asset that I really understand and I know the value of. And so we're seeing a lot of capital that's still coming into the space and interested. And I think that that's, not really geared so much towards the political side, but just due to where there are other investment opportunities and where people feel that they can get an appropriate and fair return.
I think that's where single tenant nature, 1031 buyers, private capital, family office are really attracted to that space, in addition to the institutions and foreign capital buyers out there. The single tenant market provides opportunities where you can buy investment grade real estate at yields that are likely higher than what these corporates are paying as a dividend for owning their stock shares. So, it's pretty fascinating to see, people flocking to stability, credit, term, and a fixed real estate asset. So, it's these are fixed income bonds that people are buying. And I think the demand's only going to increase, through this next cycle.
Yeah, no, I like the crystal ball answers there, because I think that's spot on too myself from what I know in this seat. Okay, guys, we're getting hit with some questions, so let's just keep them rolling here. So, how are you handling office tenants coming up for renewal, especially those with deferred rents, having difficulty making commitments to renew, and owners concerned about those balances, keeping the tenants or asking them to leave and now have vacancy? So again, very, very loaded question. I promise the next one will not be.
Yeah, I think
the
easy answer is to anybody that's an owner that's listening to this, or an advisor that is advising a landlord or a tenant. I think that everyone, this is something that's unusual, right? We haven't seen a global pandemic in a century, and everybody needs to work together to get through this time. And the people that are taking a hard line one way or another, they're going to be remembered that way. And your integrity is what you have, and your reputation is what you have, and it can get tarnished easily in this type of environment. And I would just say that when it comes to renewals and deferments of payment, everybody just needs to have an open book format. And if they really need the deferment and they can't make their rent, then I think you need to be open to that, and open to assisting that business in their longevity. And you're going to earn a business partner and develop a great relationship probably as an outcome of that.
We were very lucky with the PPP, and that really helped a lot of companies be able to maintain their rent obligations, maintain their payments to their employees. Now, it remains to be seen what the next phase of potential stimulus remains. I think that, Peter just nailed it. I mean, you're in the trenches. You got to get through the problems. You got to make sure that everyone's working together and everyone's being truthful and their legitimate requests. As that relates to what the value is on the sale, it's tough to say one way or another. I think that you look at, for companies that are strong on the credit spectrum, we've seen really good rent collection data come out over the last few months. And so as it relates more to multi-tenant offerings and tenants, some tenants may be paying or not paying. That's a little bit more of a dynamic underwriting and associated with that. But I wouldn't worry so much about, what the value is, but, working with your tenants where it's legitimate, the circumstance, to make sure that everyone comes out of this successful and on a good financial footing.
No, for sure. And kind of like a follow-up question, I guess, to that, does the panel see rental rates going down in both office industrial sectors, vacant space with no interest in the space, and landlords having to make concessions to draw interest to the site?
I think it's an interesting question, and I think it's very market specific. And
okay.
I think it really depends on what geography you're in. If you're in a dense CBD, I could likely see rents decreasing, pretty rapidly over the next 2 years. where if you're out in the suburban office, there seems to be a flight of demand coming into suburban office right now, where I don't think rents are going to increase and continue to increase at the rate that they were, but I think they're either going to stabilize or take a slight decrease. I'm not underwriting a 5 to 10% decrease in rents right now.
Okay.
In suburban office.
We talked to a lot of different owners and landlords, institutional groups, and during the last few months, rents have held steady. In some cases, have even gone up in certain circumstances. Or tenants are going into space and not requiring the TIs or different concessions. So, contrary to what may be obvious, I mean, look, I thought the same thing when this started. I thought that housing values may go down, and what have they done? They've gone up. You know, there's not housing availability in many of these Sun Belt states. So to echo Peter, it is entirely a market by market specific circumstance. But I think in many major markets, we've already seen industrial vacancy rents to be very low, and we don't necessarily see that changing. And with the office space as well, you know, the anecdotes that I was sharing were all from the office side, and you know, rents have been holding steady, tenants have been moving in, and you know, time will tell. So it's not easy to put a crystal ball on that, but again, you know, the government's been very hands-on in terms of trying to help out our various companies out there. I think as we look in, you know, some of the other sectors, maybe retail might be a little bit of a different circumstance.
Right.
You know, not necessarily so much in the single tenant, but maybe in the multi-tenant retail landscape, a little bit of different conversation. But I think office and industrial are poised to continue to do well.
Yeah, no, for sure. So kind of similar on that note, and this is a little bit you know, away from your guys' general area in Phoenix right now, but top 10 distribution markets for industrial warehouse east of the Mississippi for acquisition today.
I think, you know, east of the Mississippi, top 10. I mean, you're looking at probably the Sun Belt areas. You know, all across. I mean, there's, you know, throughout Florida, Georgia, you know, not Sun Belt, but New Jersey. You know, just follow the trends and see where there's commerce coming in. It'll be interesting to see to what Peter talked about before with onshoring. I think there's still going to be plenty of goods coming out of China and being shipped, and solutions there. But
top 10 east of the Mississippi. I mean, we're gonna have to. I mean, the Carolinas are there: South Carolina, North Carolina, Florida, Massachusetts, New York. I mean,
Georgia,
Memphis, Tennessee. I mean, there's some great markets east of the Mississippi. I'm more West Coast focused, and I've got a bias to the West just because it's a little less dense out here. But there's some great markets out east.
Yeah, no, absolutely. Well, thanks for the insight there, fellas. So kind of taking a different question or a different angle here, standard loan to value ratio for bank lenders and insurance company lenders. I know that's a little bit of a different topic here, but yeah, what are your guys' thoughts on that front?
Yeah, so on debt overall, at the beginning of this, it was the local regional banks that were the lifeblood of getting projects completed. We're seeing a lot more activity with life cos, and we're starting to see CMBS come back. Okay. So it's going to depend on term, credit, where the rent is to market, increases, but the LTV has been creeping up. Earlier on in the pandemic, we were looking at probably plus or minus 60%, maybe a little bit below 60%. We're now well at 65%, and in some cases getting closer to 70%. I can tell you on a project that we're selling right now, it's a 10-year single tenant office building leased to a strong investment grade credit tenant, Accenture, and they've got S&P A+, Moody's AA3. It's an asset that's located in Texas. They just renewed for 10 years. We have debt quotes that provide now 10 years of interest only. So, you know, talking about debt coming back. It is coming back in a very healthy standpoint. We've been, watching CMBS very cautiously through this. It's CMBS is definitely quoting and underwriting and looking to get deals completed. There's some large B piece tranches going out, and so we're very optimistic about that. And so, from life cos to banks, they're all there, and it's just really understanding the lender and the relationship and making sure they're going to follow through on what they say they're going to commit. But we're seeing very good LTVs in place in the market right now.
And I would say it's really product specific, and in the single tenant arena, if you've got credit and term, you're gonna get financed all day. And especially if it's an essential business or operation, there's plenty of capital out there that's going to want to finance that. You take the converse of that, and it's if you got a retail building and they're not open and they're not paying rent, the likelihood of getting that financed is probably slim to none. So I mean, it really just depends on what the asset is and the property level fundamentals.
Yeah, value add debt can be a little bit much more challenging at this time, and there may be debt there on the value add side or may not be there right now.
Nice. Yeah. And kind of just because someone asked about the LTV limit, on approval value or actual rent collections for multi-tenant and industrial, is there anything going on there? Just to confirm that they've got the rent coming in and things like that.
Oh, they're definitely confirming the rent's coming in. Yeah. I mean, it's confirming. Now, what's interesting, what I'd say on the office side, so we had a conversation yesterday with a large CMBS lender and asked the question, okay, well, what if the tenants, they're got a firm obligation, they're paying rent, there's no deferrals, there's no asking for concessions, but they're not in the space occupying it. So, historically, if they were dark, that would be an impediment. But just confirming that, they plan on being back in the space, we just need time. We're all in this same circumstance together. We happen to be in the office right now, but many corporates are very, very cautious in terms of getting everyone rolled back in and being very pragmatic with that. And so the lenders are not concerned if the tenant isn't in the space, working out of the space, as long as they are current and there's no arrangement worked out. So that's very positive from our vantage point. Again, if the tenant's not paying rent or there's some other circumstance, then it's a different conversation.
Different scenario, yeah, for sure. Okay, I got another loaded one for you guys, but so we've got sales trends. What are sales trends in smaller multi-tenant industrial warehouse? It seems like demand is high for this sector, but supply is low, and new construction for this sector is less profitable for developers. With rates as low as they are owner users during COVID more active buyers than investors for the multi-tenant industrial in particular?
So I think overall, take it twofold. I think overall investment trends and then owner users. Overall investment trends remain very, very strong and healthy. I think the one area where we do see certain risk factors for industrial or the other smaller tenants that are there to support local business and maybe not a large single tenant type thing. So there it's really understanding, are the tenants paying rent? How is their financial circumstance? How does their rent compare to market? Those areas, but demand is still there, and it still goes back to the underlying theme of, if the space is well located and it can be utilized by other groups. If a tenant were to leave, we're still seeing very strong interest and low cap rates. As to owner users buying, we are seeing good activity. I mean, we generally see good activity with that all around. It really comes down to what the motivation is of the seller. I think owner users take advantage of situations if the seller is willing to offer more of a discount, and they can pounce on that. But if they can get a good value for their for the real estate that they couldn't get, say, 6-9 months a year ago. If someone's willing to
Right.
sell something at a discount, we see owner users are ready to jump on that, and the financing still remains readily available. There's a project here in Phoenix that's 120,000 square foot property. That's 30-year-old building. It's Class B. It's not most modern prototype, and a user's buying that building. What I'd also say is it's also a good time for various corporates to look at sale leaseback scenarios. And so the opposite of that, where they can go take advantage of the value in the real estate to go deploy into different business strategies that they can get a higher rate of return on. And so, we expect to see an uptick in terms of sale leaseback activity as well. So
and I would echo the sale leaseback activity. I wouldn't limit it to just corporates. Even the smaller market cap and middle market cap companies can take advantage of this tool. We recently sold an asset in Los Angeles County. It was a small industrial flex facility on a long-term lease, where it was a quasi sale leaseback, and the business owner took and deployed that capital, and they're acquiring an East Coast business that's going to have synergy between his West Coast operations and East Coast operations.
Oh, nice.
And so, that asset had a long-term lease in place. There was, it closed from the listing to closing in 42 days. We generated multiple offers on it. I mean, it was a frothy activity, and it was a small market cap company with, revenues under 50 million.
For sure. That's a great story, man. I like that a lot. So we've been going for a while, guys. I know we've want to be mindful of your guys' time. It looks like that's all the questions that have wrapped up from the audience. But if anyone has any other ones, please feel free to chime in now. I just personally got a couple crystal ball questions, just what you guys think, and I know we kind of talked about it, but like in the industrial space, 5-10 years down the road, is it just as hot? Is it going to continue to be just as hot? Any slowdown, do you guys think, or is it too hard to tell right now?
I'd say no slowdown, just as hot, if not hotter. It'd be like me taking my shirt off right now.
Hey, I like that. With that background, that'd be good.
I think the fundamentals, I mean, it's pretty clear to see. I mean, there's so much evolution in terms of how we live our lives, how we order goods and services, and demand for warehouse space is going to continue to be very strong. I think we'll see a continued evolution of how people warehouse. I think we'll see, trends in terms of adaptive reuse of, big box retail, whether that's department stores or other big box. I think there's going to be a lot of innovation out on the table. We're seeing tremendous innovation come out of a major e-commerce company based in Seattle. And what's interesting is they're innovating, and investors want that product. And so we're going to continue to see the sector remain hot. We're going to continue to see capital into that space. We're going to continue to see it in the medical office space, and single tenant office will, continue to be steady Eddie and a good sector with higher yields associated with it. So, we're bullish. I mean, there's always going to be little, bumps along, dips, little rides on a roller coaster. But we're going to come into the station, and we're going to get back out, on the track, and things keep going. So we think that the entire space and sector is going to remain very strong for a long time.
Nice. We had another question just popped in. What is the cap rate range for sale leaseback? And I'm sure that could vary widely, but
what's the credit in the term?
Yeah. Peter just nailed it. Peter just nailed it right there. I mean, if you're looking at something.
Where is it located?
Yeah, I mean, there's just so many different dynamics. But what I will say on the office side, on the single tenant office side, if you've got strong investment grade credit, you've got long term on a sale leaseback, so say 15 years, you're probably mid to lower 5 caps if you're in a good marketplace. Now, and look at, if you're in a tier 1 city,
Yeah.
Say you're in Seattle, you're in the low fours.
Okay.
So, I'm talking non-tier one cities. I'm talking about more suburban in that range. So Peter just nailed it. It could be all across the board. Now,
Yeah.
you could have a poor credit tenant that is looking to do a sale leaseback on a 5-year term, and they may not be staying there, and that could be a 10 cap. I mean, it could be an 8 cap.
Yeah.
It could be, I mean, who knows? The rent could be super low, and it could be a 5 cap because the rent's so below market. I mean, with sale leasebacks, you have so many different strategies that you can employ that, to try and create a win-win situation for the investor and for the seller that really brings the partnership together. And that's the case with any sale leaseback. So it's a combination of, what is the corporate trying to achieve? What is their overall obligation? Do they not want to be in the space long term? Are they looking to free up capital to go do some other use? And so the value is important, but it's also somewhat secondary, because it's what are the strategic, operational, and financial objectives that they're looking to accomplish, and what's the investor pool looking to do, and who the right partners are to make that happen. And it might be a partial sale leaseback. It might not be a full use of the entire building. So it's not a one size fits all. It's a very complicated consultative formula, and that's what's fun about our background in operations and consulting, is really finding that right mix, and then also making sure that it's tailored so that there is the investor pool ready to buy that product. So make sure that it's something that is marketable and that there's capital for it, capital to invest, and capital that will finance those investments. So it's really a complicated type question, and it's, look at, if it's long-term and there's credit and it's a good location, yields are going to be very aggressive. There's no shortage of capital that's out there, what I would say. And even if it's sub-investment grade credit and it's still a good business, capital remains plentiful. There are plenty of private capital and institutional, whether they're US based or foreign, that are ready to work with companies to help them out on their overall strategy and buy their real estate as part of the sale leaseback.
That was a great answer to that question. Thanks for that, guys. Another rapid fire round came in. So to your point of the hot markets in the industrial market, are you seeing trends in the West in comp setting during COVID in this sector? I don't have to sell my properties, but I may, if the market is strong as it seems, sell, sit on cash, and wait for the economy to settle.
It's a perfect strategy. And we talk about this all the time. I mean, we talk about it with corporates too on the sale leaseback. When the market's super hot and there's incredible value, they should take advantage of it. But, then the market turns and they've got to go sell something at a discount. People that are sitting on really good capital, it's an individual strategy, but we recommend that, if you can free up that capital and you can go have a substantial arbitrage and people are paying very aggressive yields, go take the gains, sit on the capital, and then go redeploy it where you can go get value, whether in this sector or different sector. And so, how do you make more money? You take something that, has a value that you didn't anticipate being in there, and there's a pool of buyers ready to pay for it, and go keep that dry powder and go deploy it elsewhere. Now, I don't have a crystal ball. I can't tell you where there's going to be value adds or not, but it's the old adage, you can buy low and sell high. Why not?
I would say if you're an owner user in today's market and you own industrial in a Western location that's either primary or secondary, market, and it's, very functional real estate, and you're looking to unlock capital, there's a complete supply constraint of good product out on the market. And you would be surprised at the tremendous amount of activity that you would see for your asset if you took it in a sale leaseback scenario to market today.
Yeah, for sure. That kind of relates to the initial question we had. What do we think was hotter, or what's seen a more uptick in buy side activity in relation to Crexi from Q1 to Q2, office or industrial? The answer was actually office by a couple percentage points, but I think industrial was just so hot before that's why office has just kind of started to catch up on that. But
one thing that makes sense too, right? You get a lot of people seeking yield, right? And as cap rates compress and there's been this, huge demand for capital going into industrial, it's been really compressing cap rates. And so you've got investors out there that are looking at like, do I go buy this, 10, 15 year industrial asset or multi-tenant industrial asset at a 5 cap, or do I go buy this single tenant office or multi-tenant office at a 6 or 7 cap and get more yield out of it? And when you can get the same LTV, you're looking at your cash on cash and what's your IRR over a 10-year hold. It's really just comes down to what the investor's comfortable with and what fundamentals and risk level they're willing to take.
Absolutely. Okay, another one came in relating to foreign capital. What countries are most interested in the single tenant net lease office industrial space? You guys seen anything like that coming in?
Oh, there's plenty of them. There's Middle Eastern capital. There's Asian capital. The list goes on.
Yeah.
European capital, Canadian capital. It doesn't stop. If you want to be pretty specific, we go into the details, but that money's out there. It's half, I'd say 50% of the time there's a U.S. sponsor. And what's been really interesting this last cycle is that they've been going direct on deals without a sponsor in the United States.
What we've also seen is we've seen an uptick in terms of high net worth individuals that are coming in from other areas that we didn't traditionally see, whether it's South America or other markets. But Peter mentioned it's all over. On the single tenant side, we see a ton of Middle Eastern capital. We've seen a ton of Asian capital. There's always been, interest from our, friends up north in Canada. And then, European real estate has always been very active. And like Peter said, many times there's a US sponsor. So it could be a large pension fund or sovereign, as the money backing behind certain investments. But we are seeing a lot more direct interest, and whether that direct interest is working with the sponsor or they're just coming to us directly, and we're seeing it on smaller projects. So historically, a lot of the foreign capital has been prevalent on what I would say $100 million plus. That's still true, but we're seeing people look at projects that we have for sale, say at $30 million or $50 million or even $20 million. And so, they're looking at smaller price point assets, and that's a positive for everyone.
Yeah, and really, it makes a lot of sense to me. You can hedge your currency by owning U.S. real estate. It takes the risk off of an inflationary market overseas. We haven't seen tremendous inflation in the United States. Only time will tell with the amount of money we've been printing recently. But historically, this has been a very safe haven to park capital long term.
Yeah. Absolutely. Oh, that was great, guys. We can get your info out there, but where can folks find you guys at? I want you guys to be able to plug yourselves here too, because there's a ton of good questions coming in, and I know we're coming up on the hour here, so I want to be mindful of everyone's time.
Yeah, so I'm really accessible on Crexi. You can go onto Crexi and put in Peter Bauman, and my contact information will pop up immediately.
Love it.
You can go to our company website, Institutional Property Advisors, and you can find my information there also.
Yeah, and I'll tell you, call me. I've got my cell on all the time. I'm in the office right now, but I just forwarded to my cell anyway. So it's 954-547-7212. Like Peter said, it's easy to find our addresses, but it's just TMOFFITT@IPAUSA.com. We're happy to talk with anyone. If you're an owner, happy to strategize on your asset. If you're an advisor, if you're a broker, we're happy to talk to you and just tell you what we're seeing or give you any recommendations. And just want to be as helpful as we can for anyone out there. We wish everyone to be very well, and it's an interesting time and it's a challenging circumstance. And again, we encourage everyone just keep your head down, keep working at it. And there's opportunity to get projects done in this marketplace. We've gotten a lot of assets sold during this time, and it's a great opportunity for investors and for advisors as well.
Awesome, guys. Well, that was great. We had a lot of questions come in, a lot of rapid fire rounds there, so that was really good. I had a lot of fun. To everyone out there, thank you guys for joining us. Thank you all for joining us today. As Tivon mentioned, stay safe out there, and everyone keep the head down and keep working hard. And we'll send you an email with the link to this recording afterwards. Give us about a day, and we look forward to seeing everybody next week.
Matt, we really appreciate it. Yeah, thanks everybody. Don't forget to
Yeah.
mask up when you're not being socially distant.
Great call there, guys. Great call there. I don't have mine readily available because I'm at my house today, but for sure. That's a good note to end on.
Well, we
Thanks, guys.
appreciate
Thank you, guys.
everyone. Be well.
Yeah,
Yep,
thank you.
Thanks,
absolutely.
Matt.
Have a good one. Thank you,
Have a
guys.
great rest of the summer, all.